Hey guys, Remy here again. And on this video, I'll be talking about policy review. Now, why do I talk about policy review? I talk about policy review because there's a lot of agents out there and everybody is trying to help you out. But what I want to do is to show you how you can see and understand if your policy is designed correctly. Okay, first, have you ever investigated your policy? Have you ever asked yourself how it was designed and if the performance would actually deliver the results you want? Or is your policy designed to meet your goals, or was it just handed down to you? Because most times clients don't understand all what this is all about, and they depend a lot on the agents. And because of that, some agents are not very professional, and that they just design some things and hand to you, and you don't even know what it is. Now, what I will tell you is this. Out of my experience, I will tell you that most agents, right, design policies so they can make a fat commission from it. And at times, they don't even consider the customers or the goal of their clients. And I'll be showing you some of those policies, those poorly designed policies, how they look like. And that's the reason I've set up this video, this policy review video, to help you know if your policy was designed correctly. Now, I will recommend that if you're watching this video and you have a policy, please, it's advisable to kind of like have your policy pages with you while we go through this video. All right, now let me jump into some policies, how it looks like, and then you try to see, compare them with your policies and see the difference and understand what I'm talking about. And secondly, I also want you to understand that some policies are bad, not because the agent is bad or the agent designed it wrongly, but at times it's the company that the agent is using to design the policy, or the structure of the policy of that company's policy might be very cost inefficient. So those are some of the things that can also happen. But most times, I'm telling you, the agents are doing it for a high commission. So that is why the policy is bad. It's designed so that they have a high commission. And majority of the times, you will notice that these policies is not the company, though some of them is a company, but out of it, I will tell you 80% is the agent. Now, because even in a company, if the company might be bad, but there might be ways you can redesign that policy to still look good within that company, right? So, but let me show you this policy so that you try look at them and see how these designs actually do operate. All right, so let's look at this policy. Now, in this stage, I'm going to compare apples to apples so that you see how it looks like. Now, this is a policy designed. The client is making $602 every month, and this is a $1 million policy. It means this is a face amount, and the client also has some chronic critical illness and concierge rider and terminal illness rider. And this is he's a 30-year-old male, and this is very healthy, right? With this means the client is very healthy. Now let's look at the illustration based on the interest rate, based on the performance of the product. Now this client is using the global index, and the illustration is at it's at 7.10%, right? Now, I want you to look at one important thing. First of all, if you have your policy and you notice that the first 4 years, like almost like it takes you 5 years after in order to get cash value. Now, I want you to understand. Let me explain again. Now, this is your age during the policy life. This is the year that the policy have been. These are your premiums that you pay annually. So 602 times 12 will certainly give you this, right? This is the cumulative premiums. And this is it's like your account value, your policy value, the savings that belong to you. Now, but this is what you can withdraw. And if you don't withdraw and you pass away, this goes to your beneficiary. Now, I want you to understand something. It means for the first 5 years of this policy, of the life of this policy, the first 4 years rather of the life of this policy, you can't take out anything. That's what I'm talking about. See that? You can't take out anything. There are two reasons. One, either the company has a lot of cost into this policy, or the agent purposely designed this way so he can have a fat commission. Right? Now, so you are able to start pulling out money only 5 years into the policy. That means that if you stop paying this policy at 4 years into the policy, you're going to make a loss. You can't pull out anything from the policy. And this money is just going to get stuck in here and run your policy until it expires, except something bad happens to you. That is when you're going to make profit or make some gains from this policy. If nothing bad happens to you, this policy is going to stay and run by itself, and then it terminates. So for 4 years, you make no profit with this policy. Nothing you can pull out from it. So 4 years, you've put in a total of 28,000, but this is all you got, right? So as I said, most times it's either it's designed because the agent wants to get high commission, or maybe the company has a lot of cost. All right, and let's go down. I want you to take note of this. So take note of the number of years, 4 years into the policy before you can, 5 years into the policy before you can start pulling out anything. Right, take note of that. Now let's go one more thing. I want us to go down to the retirement age. You see, this client turns 65, right? 35 years later, and he has a total amount that he can withdraw of $610,000. Now, I want you to take note of that. Now, the first thing I want you to notice was the cash surrender. When are you able to pull out money? All right. Now, let me show you a similar policy. First, this is what the client is paying, $602, right? For $1 million, right? Now, let me show you a similar policy. All right, let's look at this. Now, this is the same client. Now, if this policy was designed using this way, look at the difference. This client is paying the same 602, right? He's paying the same 602, the same annual premium right there. And it's the same $1 million death benefit. Same age, right? Same age, male. Excuse me, male, age 30, right? Now, chronic illness, terminal illness, critical illness riders, they're all there. And this one has even overload protection rider. But look at the difference. On the first year in the policy, this guy starts pulling out money 1 year after that. On the second year of the policy, he's able to pull out money. Unlike the other policy that actually takes the client 4 years to pull out money. So he's able to pull out money just into the second year of the policy. The same amount of money every month, same policy value, same age, same client. What's the difference? It just depends the way it was designed, and it also depends on the company you are using to do your policy. Now let's go down a little bit. Now, if we go down to age 65, when this client goes on retirement, you see age 65 right here, 35 years into the policy, this client has 859,000, and he can pull out 859,000 if he wants to in this policy. Now, this is the same amount. You may ask me, look at that. This is the same interest, right? Illustrated the same interest, the same. So it usually could be what company you use, or maybe the agent deliberately designed that so that he has a fat commission. All right. So those are some of the things I wanted to show you. But now this is just for adults, right? Now, what about that of a kid? You'll be shocked. Now, let me show you the one for a baby. Now, look at this policy for a baby. Same interest rate, $1 million policy. The baby is paying $353. This is with a different carrier. And look at this. The baby has just terminal illness rider and concierge rider. Okay, good. Those are still great. And it's a male, 1 year old. Now let's look at something. If we go back, 353 every month is going to give you this a year. But this child has 1, 2, 3, 4, 5 years before this baby is able to pull out money on the 6th year. Now, on the sixth year, this child, the dad, whoever is the owner, is able to pull out just $705. Guys, let's say the baby turns 18. If you go when the baby turns 18 right here, you will notice that the baby is 18 and he's got $78,000. Now, this is not bad, right? $78,000 is not bad. And the baby can still go to school. Now, take note of this, $78,000 at the age 18, and he can start pulling out money only 6 years into the policy. And at the age of retirement, excuse me, 65, at the age of retirement, you see this child has 65 years. This child's got 2.1 million. Not too bad. But guys, I want to show you something which is going to shock you. Let's look at the same policy now. This is the same policy with a different carrier. Now the child is paying $353 as well. $1 million policy, 1 year meal, right there, right? Same policy, same interest rate illustrated. Now, but look at something. This child has chronic illness rider, terminal illness rider, critical illness rider, and overload protection. Whereas you didn't get it here, right? This is absent. You're not able to find it in here. This is absent. Okay. All right. So let's go back. Now you see this child start pulling out money, what? 1 year, 2 years, when the child is 3, the dad is able to pull out $6,000. In the other policy, guys, you are able to pull out just, where am I? You're able to pull out just zero, right? Zero right here. Now on the 7 years old, the child can pull out 705 in this other policy. But in this one, 7 years old, this dad can pull out 20,000 rather. Now this is what I'm talking about. So what's the difference? How the policy is designed and the company you actually use. Now, if you have your policy pages with you, I want you to look into that. Let's say the child turns 18. Remember, in the other policy, the child has $78,000. But in this same policy, same amount of money, illustrated the same interest rate, this child is able to pull out 114. Let's go for retirement. At retirement at age 65, Let's look at something. This child has what? 6 million that he's able to pull out. Now, if we jump back to the previous policy real quick and we fast forward to retirement, this child is able to pull out just 2 million. Now, guys, what I'm trying to show this because I want you to understand, whenever a policy is being designed, you want to look into the carrier, you want to look into the cost of the policy, you want to also look into the security of the company. You also want to also look into how quick you can get your money. It's very important how quick you can get your money. And what is the accumulation? What are the riders? Guys, most agents have actually designed policies in a way that don't favor the clients because they are only tilted to a particular carrier. They only want to sell to a particular carrier because maybe the commission they get from that particular carrier is very high. So they want to sell to that carrier. And some of them will not shop around to look at other carriers that give you different and better options. One of the things we do in our own organization is that we shop around for the best carriers for you. And based on your goals, we try to make sure that we are giving you a carrier that meets your goals. You get me? We're giving you a carrier that meets your goals, because if the carrier doesn't have the ability to meet your goals, then I bet you it's just going to be a bad policy. Now, let me show you something. If you have a policy like this, right? If you have a policy like this, right? Let me go back to that. This for the baby. If you have a policy like this, designed in this way, guys, this is a bad policy design. Most times, clients, you guys don't really know, but this policy is just handed to you. This is a bad design. You can either catch it early enough and fix it now. And if you want to learn how to fix it, please click the button to book a call, and I will show you how to fix it. Okay? Click the button and book a call, and I will show you how we can fix this.